Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Swire Pacific Limited annual report. Swire Pacific Limited is a diversified conglomerate with various business interests across different sectors. At its core, the company's operations can be categorized into 5 main divisions: property, aviation, beverages, marine and trading, and industrial. The property division is responsible for developing, owning, and operating mixed-use properties, including office towers, shopping malls, hotels, retail space, and residential projects. This division also owns and manages hotels in Hong Kong and mainland China, as well as has interests in the Mandarin Oriental Hotel in the United States. In addition to property development, Swire Pacific's aviation division provides a range of services, including flight catering, passenger and ramp handling, aircraft maintenance, and modification. The company also owns and operates a cargo terminal at Hong Kong International Airport. The beverages division is responsible for manufacturing, marketing, and distributing beverages to consumers. This includes the production and sale of sugar products under the Taku Sugar brand. Swire Pacific's trading and industrial division is perhaps its most diverse segment, encompassing a wide range of activities. These include retailing and distributing footwear, apparel, and accessories through its own outlets, selling passenger cars, commercial vehicles, motorcycles, and scooters, operating a chain of bakeries, packaging and selling sugar products, offering waste management, business consultancy, and financial services, and engaging in property trading and investment activities. Overall, Swire Pacific Limited's diverse range of businesses and services reflects the company's long history and its commitment to growth and expansion. The Swire Pacific A and B stock prices have experienced a significant increase over the past year, with a cumulative performance of plus 26.4% for A and 27.17% for B. This growth is attributed to several key news events that have contributed to the company's financial success. One major factor has been the positive full-year 2025 results announced by Swire Pacific in March 2026. The company reported a 9% growth in underlying profit, exceeding analyst estimates and driven primarily by its aviation division and significant gains from property asset sales. Additionally, the company declared a second interim dividend, raising it by 19%, indicating a commitment to shareholder returns. The company's ability to adapt to market conditions has also been evident through its strategic asset sales. In December 2025, Swire Properties announced the sale of 2 luxury houses at 6 Deepwater Bay Road for HK$2 billion, setting a new benchmark for luxury residential properties in Hong Kong and demonstrating strong market demand. Furthermore, the company's confidence in the Hong Kong market has been demonstrated through various actions. In September and December 2025, the chairman of Swire Pacific purchased a luxury property in Hong Kong for HK$50 million, signaling confidence in the city's residential market. Additionally, a company director reaffirmed Swire Pacific's commitment to Hong Kong, stating no intention to move its headquarters and emphasizing the city's development opportunities and ease of business. The share buyback program completed by Swire Pacific during the first half of 2025 has also contributed to the increase in stock price. The repurchase of HK$842 million shares can indicate management's belief that the stock is undervalued, potentially boosting earnings per share. Overall, the combination of positive financial results, strategic asset sales, and a commitment to shareholder returns has driven the increase in Swire Pacific A and B stock prices over the past year. The Swire Pacific Limited market capitalization of $300 billion is significantly larger than the average industry peer of roughly $20 billion. This shows that Swire Pacific Limited holds a significant advantage in their industry. Swire Pacific Limited trades at a higher price-to-earnings ratio of 90 times and a higher price-to-book ratio of 0.44 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 33% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 4.11%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline for Swire Pacific Limited can be identified from its recent financial performance. On the positive side, the company's beverages segment saw a significant increase of HK$25,001 million, followed by the aviation segment, with an increase of HK$4,753 million, and the trading and industrial segment, with an increase of HK$1,258 million. Additionally, property investment grew by 8.2%, while revenue from China's mainland, Thailand and Laos, and the USA also saw substantial increases. On the other hand, the company experienced declines in certain areas. The change in fair value of investment properties resulted in a loss of HK$6,073 million, while property trading and hotels also contributed to the decline. Furthermore, Hong Kong revenue decreased by 3.2% from 2024 to 2025, and Vietnam and Cambodia revenue declined by 9.6%. These factors highlight the importance of diversification and adaptability in navigating changing market conditions. Overall, Swire Pacific Limited's revenue growth is driven by its diversified business segments, while declines are largely attributed to changes in investment properties and regional market fluctuations. The net income of the company has shown an improvement, with a decrease in attributable loss from HK$163 million in 2024 to HK$326 million in 2025. However, the actual numbers for 2025 are provided as $3,495 million, but no comparison is made to previous years. The profit margins have also changed, with different segments showing varying levels of profitability. For instance, the aviation segment has a high profit margin of 24.73%, while the property segment has a relatively low margin of 7.16%. The reason for this change can be attributed to several factors, including improved operational efficiency at Delta Health, the full-year performance of the Diagnosis Intervention Packet (DIP) implementation, and streamlining operations and improving efficiency at hospitals. These initiatives have contributed to sustainable profitability under the DIP framework, despite being impacted by raw material cost inflation and exchange rate volatility. The company is indeed generating positive operating cash flow. This is evident from the financial data provided on pages 2 and 55 of the report. On page 2, it is stated that the company has generated HK$17,020 in cash from operations for the year 2025, which is a significant amount. Furthermore, the operating profit for the same period is HK$4,454, indicating a substantial increase in revenue. On page 55, the net cash generated from operating activities is reported to be HK$14,551 for the year 2025. This figure is lower than the cash generated from operations on page 2, but it still indicates a positive operating cash flow. The discrepancy between these two figures may be due to various factors, such as changes in working capital or non-cash items. Overall, the data suggests that the company is generating sufficient cash from its core business activities to cover its expenses and invest in growth initiatives. This is a positive sign for the company's financial health and sustainability. The company's debt level has undergone some changes over the past year. Initially, net debt decreased by 8% from HK$70,563 million to HK$65,264 million. However, total liabilities increased by 1.3% from HK$157.9 billion in 2024 to HK$160.2 billion in 2025. The committed loan facilities and debt securities also saw a significant increase to HK$118,313 million at the end of 2025. In terms of interest expenses, there was a decrease of 148 HK$M from 2024 to 2025. However, no explicit mention of interest expenses is made on page 69, where it only provides a breakdown of committed facilities by type and maturity. The weighted average cost of debt remained at a healthy level of 3.6%, but there is no comparison to the previous year. Overall, while there have been some changes in the company's debt levels, they are not significant enough to be considered substantial. The decrease in net debt was offset by an increase in total liabilities, and the interest expenses saw a minor decrease. The performance of various segments and regions within Swire Group's operations has been mixed. In terms of regional performance, Vietnam and Cambodia have struggled with declines ranging from -2% to -12%. On the other hand, Thailand has shown improvement, with growth rates between 0% and 9%. In contrast, certain segments have performed well. The property segment generated significant revenue of $15,992 million, while the aviation segment, particularly Cathay Group, achieved a substantial revenue of $4,753 million. The beverages segment also demonstrated strong performance in China's mainland and Hong Kong, with revenues reaching $27,482 million. However, some segments have experienced inconsistent or poor performance. The aviation segment's HAECO Group incurred significant losses of $740 million, while the trading and industrial segments, Swire Resources and Swire Foods, suffered a loss of $485 million. Additionally, the head office, healthcare, and others segment reported a loss of $61 million. It is worth noting that some segments have been mentioned multiple times in the report, indicating repeated information rather than significant changes in performance. Management is optimistic about the company's outlook, citing opportunities for growth despite market uncertainty. The focus will be on Greater China and Southeast Asia, where investments in private healthcare services, e-commerce capabilities, and commercial development are expected to drive returns. A key strategy is to deliver sustainable, steady returns through a robust balance sheet and progressive dividend policy. This will involve investing in core markets, upgrading trade mix, and enhancing marketing initiatives. The company also plans to invest $100 billion over 10 years in various projects across Hong Kong, the Chinese mainland, and Southeast Asia. In terms of specific business units, Swire Coca-Cola is expected to see sales and profit growth in Taiwan, while volume growth in Cambodia will offset higher costs. HAECO Group is prioritizing operational performance improvements, and Swire Resources expects some improvement in profit due to cost management efforts. Overall, the company aims to maintain its leadership position through strategic investments and operational enhancements. Acquisitions and divestitures are crucial components of any company's growth strategy. In this context, Swire Properties has been actively involved in both acquiring new assets and divesting non-core ones. The acquisitions made by the company include Shanghai Delta Health Cardiovascular Hospital and Indonesia Healthcare Corporation's Bali International Hospital, which were acquired in March 2025 and April 2025 respectively. The New Bund mixed-use project was also acquired with a 50% interest, while Taikoo Place Beijing was extended through an existing development known as Indigo. Additionally, Swire Properties acquired a 40% interest in a site located on Wireless Road in Bangkok, Thailand. Furthermore, the company has made significant investments in Delta Health China Limited, acquiring a controlling interest and later increasing its stake by an additional 2.31%. It also invested in Indonesia Healthcare Corporation, a hospital group in Indonesia. Pre-sales for the residences at the Mandarin Oriental, Miami were launched in 2024, indicating further expansion into the real estate market. On the other hand, Swire Properties has been divesting non-core assets to streamline its operations and focus on core businesses. These include the sale of non-core assets in USA, a non-core site in Xingyi, Hong Kong, exit from Miami Investment Properties portfolio, and sale of car parking spaces at Taikoo Shing, Hong Kong. The company has also disposed of interests in Brickell City Center Shopping Center, car parking spaces, and certain shared facilities. Moreover, Swire Properties has exited the loss-making HAECO ITM operation and decided to discontinue its airframe business in the USA. This strategic decision is expected to improve the company's overall performance and reduce losses. The deemed disposal of SHH Core Holding Limited resulted in a $31 million gain, further contributing to the company's financial growth. In conclusion, Swire Properties acquisitions and divestitures have been instrumental in shaping its business strategy and driving growth. By acquiring new assets and divesting non-core ones, the company has positioned itself for future success while minimizing losses and maximizing gains. The company's financial activities have been notable for several key initiatives. Firstly, the company has demonstrated a commitment to returning value to its shareholders through dividend payments. This is evident in multiple references throughout the annual report, specifically on pages 2, 3, and 8. In addition to dividend payments, the company has also engaged in share buybacks. A notable instance of this can be found on page 55 of the report. This strategic move not only enhances shareholder value, but also reflects the company's confidence in its financial position and future prospects. There are concerns about inventory buildup or supply chain disruption in the industry. The impact of these disruptions is evident in China, where revenue growth was affected by issues with traditional distribution channels. This suggests that there may be problems with getting products from manufacturers to customers. Additionally, other challenges such as raw material cost inflation and exchange rate volatility have been mentioned. These factors can contribute to supply chain disruption and inventory buildup if not managed properly. The industry is facing a complex set of challenges that could impact its ability to meet demand and maintain efficient operations. That concludes the financial summary for Swire Pacific Limited. Feel free to comment below, and I will be happy to answer them when possible.